Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. This is a special market update for Monday, February 21st, 2022. We hope you're all doing well on President's Day. Markets are closed, but we are not. There is a lot of fear overrunning this market right now, so we thought it's very important we come back with some more facts and figures to share with you so that we can keep calm, invest on, and make sure that short-term fear does not drive us into bad decisions that will damage our long-term financial prospects. We have a lot we want to share with you today, so I apologize in advance if this video is a little bit longer than normal. But again, we think times like these, this type of activity and information is warranted, and we want to make sure that you have all the information at your fingertips to help you understand the course that we're on and where we think we go from here. So before we get into the markets, let's first talk about what is going on. Everybody at this point, unless you live under a rock, has heard about the quote unquote imminent invasion of Russia into Ukraine. Now, everybody has become a foreign policy expert. Everybody now knows geopolitics, and we have been hearing about this for quite some time. Now, just as a disclaimer, whether or not Russia is going to invade Ukraine, personally, I have no idea. And I think anybody in the role of investment manager that tells you that they do know what the outcome is going to be is pushing false narratives. But nonetheless, that's what we're hearing, seeing, and reading about. So we want to talk about this here today in the context of the market. So first, let's talk about this imminent invasion, right, that we keep hearing about. Now, we just put together a couple news headlines just over the last couple weeks talking about the invasion that's coming any minute now, right? So obviously you can read for yourselves, but our first one comes from January 25th, right? U.S. warns Russian attack may be imminent. Right? And then we fast forward on February 1st, the Financial Times told us that the U.S. warns of an immediate threat that Russia will invade Ukraine. Fast forward further, February 11th, why a Russian invasion of Ukraine appears imminent. Okay, February 13th, 12 reasons why a Russian attack on Ukraine looks imminent. Fast forward again, February 17th, U.S. says Russian attack is imminent. Fast forward again, more on the 19th of February, right? 2 days ago, Biden warns of imminent attacks. Says diplomacy is still possible. Again on the 19th, Russia holds nuclear drills ahead of imminent attack on Ukraine. The Wall Street Journal jumps in there. U.S. warns of imminent Russian invasion. So you guys get the point, right? Whether or not this attack is coming, I don't think anybody really knows at this point. It's kind of hard to say what Putin's going to do, and ultimately, if past is a guide, he's a very hard guy to figure out. But you see how the media has really spun this narrative up. And I say this not to pick on the media, but we know the market is a forward-looking mechanism, right? So if it's a forward-looking mechanism, that means it prices in the probability of events happening. And from our seat here, we would argue that the market has priced in a lot of worst-case scenarios, right? Around interest rates, about inflation, and now pricing in the probability or possibility, however you look at it, that Russia is going into Ukraine. Now, I think it's important for us to understand if an invasion is imminent, well, let's look at history as a guide to say, well, how do stocks normally perform during geopolitical events? And history tells us they tend to take them in stride. Now, I'm not going to read the whole list here. Obviously, it's there for you to review, but there's a lot of major both U.S., domestic, and global events listed on this. And the biggest one I like to point out, right, 9/11 was a very dark day here in America, really a cataclysmic type of event. And yeah, when markets reopened from 9/11, the markets did fall 5%, which is a big single day drop. But when we fast forward, right, the bottom was 11 days later, and it took the market only 31 days to recover, moving back to previous levels higher than when 9/11 happened. And we see a lot of other instances here where the market recovered rather quickly, and it was the anticipation leading up to that event that actually caused the market more problems than the event itself. So, I think that's something to keep in mind. Everybody thinks it's so obvious that an invasion or war is bad for the markets, but we would argue that most of the pain happens before the activity occurs, and it's what comes thereafter is when the recovery gets started. So, let's take a look here. Let's take a look at the market and talk about what we've seen in this market over the last couple months. Now, we know we've been in a fierce correction. We believe that correction bottomed on January 24th, and that's what you're seeing here with this line. Let's zoom it in a little bit, okay? The market came down in a precipitous fashion Monday, January 24th. We saw a big move down followed by a big rally intraday. Markets closed higher. That's usually the sign of capitulation in the market. Capitulation tends to be like a selling climax where many investors give up, and that actually marks the bottom. Now, it's important to understand bottoming is a process that tends to be messy, and that's what we're seeing here, right? It's not uncommon for markets to create a bottom, carve out a bottom, bounce off that bottom, and then back test it, right? And it's in this back test where we are right now that everybody throws their hands up and says, "Oh no, and here we go again," right? And this is very important to understand how markets behave and the patterns that they throw at us, because this is a recognizable and repeating pattern. What's very important is this recent pullback, this back test, has been on declining volume, right? So the initial sell-off was on a big volume spike. That's what these bars at the bottom here. Big sell-off and volume spike followed by big buying, right? Buying climax. That's why we saw a massive amount of shares trade hands on this one singular day, over 200 million shares. And this sell-off ever since, if we look at this, has been on declining volume, okay? Which tells us that even though it's painful, it's not nearly as meaningful. The market is running out of sellers. Well, how do we know the market is running out of sellers? Well, I'll point to a chart that we've been using recently, and this is looking at the NASDAQ over 30 years, okay? And it measures the number of stocks in the NASDAQ, and this would look the same if I put up the S&P 500 or the Dow Jones. And it's measuring the number of stocks that are hitting new 52-week lows. And this is one of the tools that we use to identify when a bottom is in place. And what we've seen, and this really climaxed on January 24th, and it started to improve there since, is we saw more stocks in the NASDAQ hitting 52-week lows in the beginning part of 2022, more than the financial crash or the Great Recession and the financial crisis of 2008, and even more than the tech bubble of 2000, right? The tech bubble, when we had hundreds of companies in the market that were totally worthless, yet trading at billions of dollars of valuation. So when you put it in context and you say, is this economy today worse than 2008 or worse than 2000? Not even close. But sometimes stocks get irrational, and when they act irrationally, this is the type of behavior that we see. And that's one of the things really that is, it's a gift and a curse with what we call Mr. Market, right? Mr. Market comes back to you each and every day with a new price that he's willing to pay for the investments you own. And if you don't like what he's offering you today, well, fear not, he'll be back again tomorrow. And sometimes we go periods of time where we don't like the price that Mr. Market is willing to give us for the investments, the underlying investments that we own. And this is why a lot of American investors tend to do a lot better with real estate than they do with stocks, bonds, and mutual funds. And the reason is even though real estate values change all the time too, people don't live through the price swings in their real estate, right? You don't go on Zillow every day and check the value of your home and feel the pain when the value of your home declines, right? I'm sure many people, probably 80+% of people watching this video, owned real estate right through the housing crisis of 07 through 09, where the real estate you own might have declined by 40 or 50%. But because you were not interested in moving, because you knew your house was worth more than the market was currently willing to pay you, people did nothing. They held on. Their investment came back. And this is why you hear all the time about people who bought a house in the 70s or 80s or even, generational family stuff. They bought it 50s and 60s and they've made massive profits because they didn't blink every head fake that the market came at them with, and they weren't forced into a bad emotional decision. So, again, that's the tough thing about Mr. Market, right? He comes back to us every day with a price. But the good thing is, if we don't like the price that Mr. Market has given us, we don't have to take it. And this is why we want to be long-term in our mentality. And when I say long-term, I don't mean 20 years. Certainly being a 20-year investor is a great thing. But we know for some people, it's a 1-year, 3-year, 5-year, 10-year time horizon. It's very important to remember that when the days, the weeks, and the months get ugly, we still have a longer-term view of this, and we know that investors are rewarded over those time frames. So let's take a look at the market, right? We think we had that bottom on January 24th, and now we're bouncing and creating what we call a wedge here, right? Where we have a little bit of overhead resistance, and we have a little underneath us support. Now, so far, the market has created what we would call a higher low, right? Where this low is higher than this low. This is a good thing. Now, we very much would expect the market is going to test this lower level here, right? It's going to probably retest the January 24th low, and that is okay. Okay, if we look back at previous times during the course of the last couple of years, right, even just going back to last year, February and March, when markets had made a high, then a low, then another high, then another low, but this low was a higher low, right? So that's what we're looking for. And we think that nothing has changed. I've come on here for the last couple videos and podcasts talking about this. Bottoms are messy. Bottoming is a process. And right now we're getting good signs that this market is working through a bottom. And while it does feel messy, while it does feel choppy, this is exactly how they are supposed to feel. So the problem with markets is when people get scared, right? And let's zoom out. Let's put this into context here. Okay, the market's come a long way from the March 2020 low. Okay, the market more than doubled off the March 2020 low, and now we're giving back a little bit of those gains, and people are very scared. Now, naturally, people are always going to be scared, when investments decline. But I think because of all the other things going on in the world right now, inflation, interest rates, and now this geopolitical Russia-Ukraine thing, people are more scared, right? And they think it's going to be the end of days. And when people get scared, they forget about the future, right? They discount the future. I don't care about growth anymore. We don't care about the future. We think this is the end of days and we probably should sell everything, right? That's the prevailing sentiment in this market right now. And we're seeing that through the different institutional investor readings where the level of bullishness has dropped to below 20% of all investors, right? So 18% of investors, institutional investors, folks like us and counterparts, competitors, etc., only 18% of investors are bullish right now. Now, it might sound like a bad thing, but right now everybody is crowding on the same side of the market, right? It's like we're in the casino in Vegas, everybody's around the roulette table, and the entire table's betting on red. Okay, well, they might win a couple times in a row, but eventually, contrarian indicators would suggest that the house always wins, and when everybody piles onto one side, the market is getting ready to do the other thing. And we expect that to be the case here as well. So when we look at this, people forget about the future, right? And we've seen declines like this in the past where really good companies have gotten sucked into a decline and something that somebody thought or people or the great masses thought was the next greatest investment opportunity has now been left into the rubble and people think it's going to zero. So let's take a look at a couple of these that I think are very relevant because this is going to kind of paint the picture that we know the market's being irrational because it's totally discounting the past, the future, and a lot of good news in the current. So first, let's take a look at Amazon, okay? When we look at Amazon over the course of 20 years, right, it's been a phenomenal investment for anybody that's been in. And it's very hard to buy these investments when they're brand new, right? In 1997, nobody really knew what Amazon was or what they could be. But the reality is you always hear people, man, if I would have just bought Amazon in 1999, I'd be a billionaire on a yacht somewhere. Well, the reality is if you bought Amazon in 1999, you probably would have panic sold it in 2001, right? And Amazon has been more than cut in half several times during its tenure in the market, right? And when it first came public, and I'm going to use this as a comparison to some of the other companies that we're more familiar with, but when it first came public, right, it was the greatest thing since sliced bread. And then it went on to decline by 80%. And we were hearing a lot of the same things then that we're hearing about companies in this market now. Their best days are behind them. There's no future for them. The growth is gone. This was a fad, et cetera, et cetera, et cetera. Then Amazon went on to continue higher, only to lose another 60%. Let me just zoom in a little bit so we can see this a little bit better, right? So this was the initial decline. Then Amazon went to lose another 60% through the financial crisis, okay? And obviously we know the story and we know where Amazon went from there. And just for some facts and figures, an investor who would have invested $10,000 in Amazon in 1997 would have $19 million today. And okay, maybe if you were a late comer, you weren't going to buy an IPO, you waited 10 years until you had a feel for what this company did, and you came in 2009 with that same $10,000, you'd have $1.2 million today. So this is what markets have the opportunity to present, amazing compounding growth, but the price we pay for that growth is volatility. So, and how do I know, right? How do I know that the market is being irrational right now? Well, we know it's being irrational when good news happens for a company and the market totally discounts it. And I'm going to give you an example of that, okay? Many of you are probably Prime users, right? So you probably saw this email come into your inbox where Amazon announced they are raising the price for their Prime subscription, right? The first price hike since 2018 has now gone into effect, which will take the annual cost of Amazon Prime from $119 a year to $139 a year. Now, I don't know about you, but as a Prime user, this $20 increase is not something that's going to keep me from continuing to be a Prime subscriber. But folks, this is a $400 billion email for Amazon, okay? This price increase with the user base they have will generate an additional $400 billion in the next 12 months or long. Now, for a company that's around the $1 trillion market cap in size, an additional $400 billion in revenue should be a substantial event of good news for the stock. And what has happened? Nothing. Absolutely nothing. The stock's actually gone down over the last couple of months, and even with the announcement, we didn't get much of a bump. So you might say, well, Mike, that's a bad thing. Good news and the stock's not reacting. No, sometimes good news and gratification in the market is delayed. It's not discounted altogether, it's just delayed. And when you see good news like this happening in the market and stocks ignoring it, that's how we know they're being irrational. So I thought that was a good example, and I wanted to share that with you as well. Apple, another bellwether stock for this market, right? Everybody loves Apple. You could have been a billionaire if you invested in this in the IPO, but again, we know it's tough to catch an IPO, but growth stocks go through fits sometimes, right? Apple has been more than cut in half on 5 separate occasions throughout its lifespan, and on 3 separate occasions, it declined by more than 80%. We saw that in the tech bubble of 2000, right? Now, Apple was not in a bubble. It was a fantastic company, but it still declined as the tide lifts all boats up when it's on the way up, and it pulls all the boats down when the tide is sinking. Then a couple of years later, in the financial crisis, let me zoom this in a little bit so we can see it a little bit better. In the financial crisis, we saw Apple again decline by more than 70% before going on another run into 2012, where it declined. I think at this point, the decline was about 65%, okay? So again, Apple, we know, has been up and to the right for most of its career, for most of its time in the market, but these types of things happen with growth stocks. And it's always the same feelings and sentiments when they do. On the way up, these are the greatest companies ever. On the way down, they are a scam, they're a fad, they're never going to recover, they're going straight to zero. Okay, this is how growth stocks behave from time to time. And the last example I want to share with you is that, we own Roku. Okay, we own Roku. We think it has tremendous potential, but in the short term, Roku has been a tough own. Now, thankfully, we didn't buy it up here at the top, right? We started buying it on the way down when we thought it was at a discount, but Roku had some plans to continue to go down. Now, when Roku first came into the market, it really has not been around for that long. We're talking about September of 2017, so still a fairly new company. And as they started to ascend and appreciate, we heard things like this is the next Netflix. Well, I think if people were comparing it to the next Netflix, they probably should have went back and looked at how Netflix behaves, okay? Netflix has been cut in half or more many times during its period on the market, right? Here's that Netflix goes public, similar to Roku, right? Greatest thing since sliced bread, and then boom, 79% decline in the early mid-2000s. Fast forward, 2011, again, 70+% decline in Netflix, and obviously we fast forward, and the stock right now is in an almost 50% decline, give or take a few percentage points. This does not mean there's problems with these companies. This is just how growth stocks behave from time to time. So we thought that this was a really important comparison to make, because when we go back and look at Netflix in its infancy, it looks very similar to Roku right now. Now it remains to be seen if Roku will become the next Netflix. But again, for all the comparisons on the way up, I think it's important for people to go back and say, hey, if we think it's going to be the next Netflix, then maybe we should look at how Netflix behaves and not be so surprised when these things pull back. So we understand, listen, declines are brutal, they're painful, and there's been a lot of velocity to these declines. And the reason that this decline has been so different for folks is because stocks and bonds have declined together, right? That's generally not something we see happen very often. Usually when you get risk off in the stock market, people rush into the bond market for the degree of safety. But because of the fear of higher interest rates, right, all we're hearing and seeing is that both asset classes are declining together, and it has investors in a frenzy. These types of things happen from time to time. The market is working through some situations and problems, and it's rushing to price in the future probability of these events. So Is Russia going to invade Ukraine? I have no idea, and I am not paid to try to answer that question. What we are in this position to do is to try to decipher what would that impact be and how should we react and respond to those events. And sometimes some of you might wonder, right? I'm sure you're looking at the portfolio, maybe you're watching the videos, but you're saying, hey, I don't see much activity going on, buying or selling or otherwise. Because sometimes the right thing to do is nothing. And I want you to know, just because you might not see any activity for a couple days or a week or 2 weeks does not mean that we have our eyes off the ball. We're here, we're behind the wheel, but sometimes the activity that's warranted is to do nothing. And when the market is highly irrational, we will refuse to play into that irrationality. So that's why we wanted to show you where we think we're at in this cycle. We're looking at, let me just get this out of here. Okay. We think the market is working on a bottom, and I'll show you the S&P 500. It's the same concept there, okay? The market is going through some things. I don't know where all these lines came from, but let's get these out of here. But the market has a memory, okay? The market has a good memory. So as this correction unfolds, same thing with the S&P. You get the initial move down, we get the bounce, and now we're working on that back test. Well, wouldn't you know it, that the market is testing some levels that it previously messed around with earlier, or I shouldn't say this year, last year, right, in late 2021. So what we're looking for to see is if we have what we call support at these levels, at previous levels where the market bounced, right? Bounced off this level once, we bounced off this level again, and we believe that we will bounce off this level yet again. So as far as what's going to happen with the news flow, it's continually coming at us. Markets are reacting to it, but a lot of this is on lighter volume, folks, which means we're running out of sellers. And right now, everybody is in the markets moving to one side to bet against this market. The pendulum is swinging hard to one side, and we're running out of sellers. And at some point, when these news events that we've had fear and anticipation now for such a long time now, as they start to work their way through the market, right? The Fed gets on with it and eventually does their interest rate hike or multiple hikes. Putin decides what he's going to do and when he's going to do it. The market has already priced these events in, and there will be a stampede of buyers coming back into this market. So for tomorrow, Tuesday, when markets reopen, we would likely expect to see the market open lower, right? Because again, you still have a void of buyers right now, folks like us that want to buy the dip, we want to buy the bottom, but catching the exact bottom is a fool's errand, so we don't want to rush in too soon, and that is okay. Some of the best opportunities in the market are when the market opens lower, like it did on Monday, January 24th, and then buyers emerge, they step in through the course of the day and push the market up higher. And if we can get that type of confirmation at these previous levels that we've retested, we think that would be a great indication that not only is the bottom in, but the market is building something and we're getting ready to move higher. And make no mistake about it, when all this stuff flushes through the system and markets do start to move higher in a meaningful way, it's going to come quick and ferociously, and a lot of people who are out of this market or short this market, right, betting against it, are going to scramble to get back on the right side. So we wanted to get the information out. If you have any questions, please reach out to us. We're going to keep coming with this information. The best way that we can fight fear is with facts. And as we said before, nobody's ever made a dime in this market by panicking. We believe that our investors will be rewarded for having a longer-term mentality, not getting sucked into the short-term noise, which we think a lot of this is noise. So if you have any questions, reach out to us. Thanks for watching, and we'll see you back next time.